Did you know that more than half of the US households are invested in the stock world? The fascinating world of investment is attracting more and more people every day, and investing in stocks can help you build your savings, protect your money from inflation and taxes, and minimize income from your investments. So if you're looking to invest for your future 5, 10 or 40 years off, then now is as good a time as ever. But if not knowing much about stocks is stopping you, then fret not, we're gonna dive deep into that today. First of all, some introductory facts about stocks. When you invest in stocks, you're purchasing a share of a company. They're basically a slice of ownership in a company that can yield returns if it is successful. Common stocks allow shareholders to vote on company issues, with most companies granting one vote per share. Some companies also offer stockholders dividend payouts, giving investors a stream of income on top of the market value of the stock. Investing in stocks has become increasingly accessible, with beginners able to open an account with little money through a brokerage's website or mobile app. So now we'll be taking a look at step-by-step instructions to give any beginners a proper idea of how to get into the world of stock. Number 1. Figure out how much to invest. The first and most important part of investing in stocks is to set a budget. How much you invest depends entirely on your budget and time frame. Yes, you may invest whatever you can comfortably afford, but experts suggest that you should leave your money invested for at least 3 years and ideally 5 or more so that you can ride out any bumps in the market. So while setting up your budget, try to figure out an amount that you don't have to worry about in the upcoming 3 years at least. In case you're wondering what the minimum amount is, most major online brokerages these days don't have an account minimum, so you can get started with very little money. Number 2. Fixing your investment approach. So after you've determined how much you'll be investing, now it's time to decide how will your money be managed. These days you have several options, meaning you can really match your investing style to your knowledge and how much time and energy you want to spend investing. The first option is human professionals. This do-it-for-me option is a great choice for those who want to spend just a few minutes a year worrying about investing. The professionals will be taking care of it all. Then you have Robo advisors, the online version of professionals. This is another solid do-it-for-me solution that has an automated program to manage your money using the same decision process a human advisor might, but at a much lower cost. Lastly, there is a brokerage where you can manage your investments by yourself. It's all about you. If you think that you have a greater understanding of the stock markets and also spare time to manage your investment, then it's the greatest option. Number 3. Define your investing strategy. After the investment approach, it's time to figure out your strategy. No matter which approach you decide to go with, after that you will have 2 different investment strategies to choose from. Passive investing. Take a buy and hold approach. Passive investing is a way to DIY your investments for maximum efficiency over time. A buy and hold strategy focuses on buying investments and holding on to them as long as possible. Instead of trying to time the market, you focus on time in the market. Active investing. The other strategy is an active approach to investing that requires buying and selling based on market conditions. Unlike the previous one, it requires you to be more active in the stock market. You hope to maximize gains by buying and selling more frequently and at specific times. Number 4. Try to focus on long-term investments. Stock market investments have proven to be one of the best ways to grow long-term wealth. Over several decades, the average stock market return is about 10% per year. However, remember that's just an average across the entire market. Some years will be up, some down, and individual stocks will vary in their returns. For long-term investors, the stock market is a good investment no matter what's happening day to day or year to year. It's that long-term average that they're looking for. Number 5. Manage your portfolio.
If you are not a professional investor, if your goal is not to manage money in such a way as to get a significantly better return than the world, then I believe in extreme diversification. I mean, so I believe 98 or 99%, maybe more than 99% of people who invest should extensively diversify.
So as Warren Buffett suggests, as a beginner, don't try to put all your eggs in one basket. By investing in a range of assets or diversifying, you reduce the risk that one investment's performance can severely hurt the return of your overall investment portfolio. You also want to continue to add to your portfolio, so consider setting up auto deposits each month. You can also reinvest any earnings or dividends to help build growth over time. Ready to get into the investment world? Then you'd surely want to know how Warren Buffett thinks you should spend your first $10,000. Watch our next video to know that. See you in another video, Surefire gang.